moving averages are a vital tool for traders. They help make sense of market movements. Many successful traders rely on them daily. This guide will explain moving averages simply. You will learn how they work and how to use them. Moving averages can improve your trading decisions. Why are moving averages so powerful? What exactly is a moving average? It is a continuously calculated average price. This average covers a specific number of past periods. For example, a 20-day moving average uses the closing prices of the last 20 days. Each day, the oldest price is dropped and the newest price is added. This makes the average move over time, creating a smooth line on your price chart. The main purpose of a moving average is to identify the direction of a trend and define potential support or resistance. By smoothing price data, it reduces volatility's impact, showing the underlying momentum of the market. Traders use this information for making decisions, helping them decide when to buy or sell. Moving averages are versatile in their application, working across different financial markets. The key is to choose the right period length, depending on your trading style and goals. We will discuss period selection later in this guide. The simple moving average, or SMA, is common and easy to understand. It is calculated by summing recent closing prices and dividing by the number of periods. For example, a 10-day SMA adds the closing prices for the last 10 days and divides the total by 10. The SMA gives equal weight to all prices, making it react slower to new price changes. Some traders see this as a disadvantage, preferring an average that responds faster. However, others see this slowness as a benefit, providing a more stable view of the trend. It is excellent for longer-term trend following. The choice of the SMA period is crucial. Shorter periods are sensitive and useful for short-term trading, while longer periods show the longer-term trend direction. A 200-day SMA is a widely watched benchmark, often considered the line between bull and bear markets. Experimentation helps find what suits your style best. While the SMA is useful, other types exist. The exponential moving average, or EMA, gives more weight to recent prices, making it react more quickly to new information. Traders who want faster signals often prefer EMAs. Another type is the weighted moving average, or WMA, which emphasizes recent prices in a linear way. The most recent price gets the highest weight, and the calculation is more direct than in EMAs. The triangular moving average, or TMA, gives the most weight to the middle data, creating an even smoother line than an SMA. Which moving average type should you choose? There is no single best type for everyone. SMAs are good for smooth, long-term trends, while EMAs are better for shorter-term, faster signals. WMAs offer faster signals with linear weighting, and TMAs provide maximum smoothness for cycle analysis. Many traders experiment with different types to see which one fits their trading style best. Often, the choice depends on the market traded and the time frame being analyzed. Section 5. Trading with a single moving average. Clear signals. Using a single moving average is a basic strategy that can be quite effective. The primary signal comes from price crossovers. When the price crosses above the moving average, it can be interpreted as a buy signal, suggesting upward momentum. Conversely, when the price crosses below the moving average, it can be seen as a sell signal, indicating downward momentum. The choice of the moving average period is vital. Shorter moving averages give more signals but can be less reliable, while longer moving averages give fewer but more reliable signals. This strategy works best in trending markets. In sideways or choppy markets, it performs poorly, leading to many false signals. Therefore, it is crucial to identify market conditions and use other indicators or analysis to confirm. No single indicator should be used in isolation. Section 6. The double crossover, using two moving averages. The double moving average strategy uses two moving averages of different lengths. One is a shorter period or faster moving average, and the other is a longer period or slower moving average. Trading signals are generated when these moving averages cross, often called a moving average crossover. A buy signal occurs with a golden cross when the shorter moving average crosses above the longer moving average, suggesting strengthening short-term momentum. Conversely, a sell signal occurs with a death cross when the shorter moving average crosses below the longer moving average, indicating weakening short-term momentum. The double moving average strategy also has limitations. It is a lagging indicator and crossovers happen after the price has already moved. In sideways markets, it can produce whipsaws, generating losing trades if not managed. Confirmation from other tools is wise, and risk management is always essential for success. This strategy aims to reduce false signals from single moving average use. It is a widely followed technique by traders. Section 7. Finding price cycles with moving averages. Markets often move in cycles of highs and lows, and identifying these cycles is crucial for traders. Moving averages help smooth price action, making underlying cyclical patterns more visible. A correctly chosen moving average can highlight cycle bottoms and spot potential cycle tops, giving traders a significant edge. To identify price cycles, observe moving average behavior. When price consistently finds support at a moving average and then turns higher, it could indicate a recurring cycle bottom. The length of the moving average should approximate the cycle length. Moving averages can also help identify cycle tops, although this is often harder than finding bottoms. Combining moving averages with oscillators can improve this technique. Historical analysis is required to identify dominant cycles first. Section 8. Moving averages as dynamic support and resistance. Moving averages can act as support and resistance. Unlike horizontal lines, they are dynamic and change with price. In an uptrend, a moving average can act as rising support, providing potential buying opportunities. In a downtrend, a moving average can act as falling resistance, offering potential short-selling opportunities. The reliability of a moving average as support or resistance depends on how often price has respected it. The period of the moving average is also important. For example, the 20-period exponential moving average is popular for short-term traders. The 50-period moving average often acts as support in medium-term uptrends and resistance in medium-term downtrends. The 200-day simple moving average is a major long-term level, widely watched for trend changes. When using moving averages as support or resistance, look for price to touch the moving average and then react. Always use stop-loss orders to manage risk, protecting against breaks that continue strongly. Section 9. Conclusion. Moving averages, your trading ally. We have explored moving averages in this guide. They are a simple yet powerful analysis tool. Their main job is to smooth price data, helping to identify trends more clearly. We discussed types like simple moving average, exponential moving average, weighted moving average, and triangular moving average. Each has its own characteristics and uses, and choosing the right type depends on your style. We covered practical trading strategies including single and double moving average crossovers. Moving averages also help identify price cycles and act as dynamic support and resistance levels. They are easy to understand, calculate, and apply, making them accessible to traders of all levels. However, remember, they are not standalone systems and work best in trending market conditions. Mastering moving averages is a worthy goal, leading to more disciplined trading and potentially more consistent results over time.